How do you stick to your investment plan when the market is down? How do you stick to your investment plan when the market is up? And are the days of credit and debit cards numbered? We'll answer these questions and more on this, the 118th episode of the DoughRoller Podcast.
Welcome to the DoughRoller Podcast, where the best thing money can buy is financial freedom. We help you make more, spend less, and invest the rest. And now your host, Rob Berger.
Whether you're just starting out, buried under a mountain of debt, or well on your way to financial freedom, this is the podcast to help you take your finances to the next level. Hey, everybody. Hope you're having a great day. I am sitting here recording this podcast at the end of a market, at the end of a day. The market has been down. Let's see here. The Dow is down 1.6%. The S&P 500 is down 1.51%. NASDAQ 1.56%. Definitely a tough day for the market, and I think a perfect time to record this particular episode, where the main topic is going to be, how do we stick to an investment plan? Don't you just love the experts? They say, have your asset allocation plan and you just stick to it. Doesn't matter what happens in the market, just stick to it. Well, that's good advice. I think most of us would agree, except that it's one of those things. It's simple. It just ain't easy, right? And maybe you've been there before. Maybe you've already done this, where in a down market you got scared, you got nervous, and you pulled a lot of the money out of the market, and then you later came to regret it. Or sometimes the reverse is the case. Maybe you let your asset allocation drift away as stocks went up in value, and maybe you started out at 60% stocks, and you just couldn't reallocate because the stock market was doing so well, and you found yourself at 65, 70, maybe 75% stocks. And then you had the crash. Then you had the bear market. You had a downturn, and you kind of wish you would have stuck to your plan. How do we do that? I mean, some people just seem to, they just can stick to their plan. It's just who they are, whatever. It's their mindset, whether it's from experience or not. They just seem able to shake off the ups and downs of the market and stick to their plan. And maybe that's you, but I know for a lot of people, it's not so easy. And so what I thought I would do today is walk through, let's see, I've got basically 8 tips, things that have helped me learn to stick to my investment plan. And so we're going to walk through those. And actually, I may have a couple of bonus tips as well as I think about it. I will have a bonus tip. Maybe I'll come up with 9 here. But that's what we're going to try to do today. And some of these are very practical. These aren't just, suck it up and, just stick with it. I mean, that doesn't help anyone. I mean, we all know that's what we should do. The question is, how do we do it? How can we somehow prepare ourselves now so that when the market is down a lot, of course it was down today, but I'm talking down 10, 20, 30, 40%, then what do you do? Or when it's up like it's been, how do we stick to our plans then? And so I think now is the time to address it when, the market's been down the last few weeks, but overall, obviously, the last few years it's been up. And so, let's prepare now for the difficult times so that we're ready when they do come, and they will. And so that's the goal of today's show. I'm going to walk through those tips with you today, and hopefully it will help you. That's what we're going to do. And before we get to that, though, I do have a reader question that I want to share with you. And then I have for the tip of the day, it's actually two tools that a reader emailed me about that I actually think will not succeed, actually. That's my take on them. But they're really cool, and I'm going to share them with you, and I'm going to tell you why I think they haven't even officially launched yet, and I think their days are numbered. And I could be wrong, but that's my take on it. We'll cover that at the end of the show. So let's get right to it. The first email is from a listener named Tom. He wrote in, he said, in your traditional 401k versus Roth podcast, you mentioned that the RMD, that's the required minimum distribution, is not a requirement of Roth 401k plans. My plan administrator, Fidelity, told me otherwise, i.e. there is an RMD requirement. The person I discussed it with did not instill me with the greatest confidence. Okay. She had to put me on hold forever and ask someone else, and I was wondering if there is an IRS resource or some other way to confirm this, or does it vary by plan? I chose the Roth 401k for tax diversification in retirement and hope for the no RMD with the Roth. My wife maxes her traditional IRA, and we both have pensions, which will keep us in the highest tax bracket in retirement. Man, what a great problem to have, huh? I still think I will keep the Roth 401k option, but would feel a lot better if the RMD requirement was not a feature of my Roth 401k plan. Thanks in advance. Again, thank you for your great podcast. Well, that's a great question. I'll be honest with you. I didn't actually go back to the podcast that Tom referenced to see if he's right, if he remembered it correctly, or did I misspeak? But here's the deal. A Roth 401k plan absolutely does have a required minimum distribution. When you hit 70 and a half, you must take the RMDs from a Roth 401k. You have to. Now, that may be a surprise to some of you because you say, well, wait a minute, I'm pretty confident there's no RMD for a Roth IRA, and you would be correct. But for a Roth 401k, there is. Now, the good news is you can always roll over your Roth 401k to a Roth IRA, and voila, you don't have the RMD. You can avoid the required minimum distribution by rolling it over before you're 70 and a half to a Roth IRA. But there is an RMD for Roth 401k plans. And so if I said otherwise, and I need to go back and re-listen to that podcast, but if I said otherwise, I was incorrect. There is an RMD for a Roth 401k plan. There is not one for a Roth IRA plan. By the way, in Tom's email, he mentioned tax diversification. You may be familiar with that term. Some of you perhaps not. It's something to think about. When we talk about, a traditional IRA versus a Roth IRA, which one should you go with? One of the things I always stress is that the answer is not all or nothing. The best answer for you might be a combination. You can't increase your contribution limits. They're still the same regardless of whether you put everything in a traditional IRA, a Roth IRA, or a combination of both. Same is true with a 401k. But oftentimes you might want to do a little bit of both as a way to diversify the tax treatment of your of your retirement accounts. Obviously, if you know with perfect insight exactly what your taxes will be for the rest of your life, you could just pick the best outcome. But I think for the vast majority of us, probably all of us, we don't know that. Now, it's interesting in Tom's case because of his pension. He believes he'll be in the highest tax bracket. So, that could weigh in favor of Roths now if he's not in the highest tax bracket. But he's right to think about tax diversification. I think that's absolutely a valid consideration when you are deciding between a traditional retirement plan, 401k or IRA, or a Roth version of it. You might want to do a little bit of both to diversify your retirement funds from a tax perspective. Obviously, we talk about diversifying our investments from, stocks versus bonds, for example. But tax diversification can be very important too. So again, Tom, appreciate your email, and there you go. Again, I need to go back and look at that listen to that last podcast to see what I said. maybe I misspoke. I'm sure it wouldn't be the first time, and I know it ain't going to be the last. But there you go. And that's one of the things I love about you guys is I get great email to folks saying, no, either you got this wrong, or here's some other things you should consider, and whatever. I had that. I don't have the email in front of me. I think I may mention it in a future podcast, but I got one email. This is kind of an aside, but we were talking about we had the podcast on a listener got an inheritance. Do you pay off the home or invest for retirement? And I should be looking these numbers up for you so you can actually go listen to this. So this one I'm referring to is podcast 108. DoughRoller.net/podcast 108. Pay off the mortgage versus invest for retirement. And one listener emailed me and said, well, you forgot a factor. And the question is, would you ever borrow against your home to invest? And if the answer is no, then you should pay off your mortgage first, because otherwise you're effectively doing the same thing if you invest that inheritance rather than pay off the mortgage. It's really no different than borrowing against your home to invest. And, I thought a lot about that. I've heard this argument before. It's never kind of sat well with me. And I mean, I understand the logic to it, but I think in practice, I kind of wonder about it. For example, would you borrow against your home to take a vacation? But actually, some people would. People do it all the time through a home equity line of credit, right? They borrow against their home to go out for dinner. They borrow against their home to buy the latest iGadget. They borrow against their home to go on vacation. But I think a lot of us would say, no, I wouldn't do that. I'm not going to borrow against my home to go on a vacation. Well, I suppose you could take the same logic and say, okay, then you can never go on a vacation until your mortgage is paid off. So I'm not quite sure that's the right way to look at it. But, I'm guessing some of you have an opinion on that. So feel free to hit me up with an email, dr@DoughRoller.net, and let me know what you think. But I kind of went into a little footnote there, a side issue. The fact is, you guys have been great at emailing me when I miss something or just adding to the conversation, and I try to share as many of those emails as I can. I still have a long, long list of things that I want to share, and I usually pick one or two each episode. But I mean, I've got stuff to share for like the next 25 episodes, probably 50. I mean, it's been great. It's great stuff. And, one of the things I've mentioned, I love to hear about tools and calculators and resources. And in fact, when we get to the end of the episode today, as I mentioned, the tool of the day, or actually two of them, comes from a listener. So we're going to hear about that in a bit. But I love getting those kind of emails. I kind of collect them and save everything in Evernote, which is sort of the way I save most stuff. And anyway, we'll get to that in a minute. The main topic, this is so important. How in the world do you stick to your investment plan? We all know we should. We all hear, we should be greedy when others are fearful and fearful when others are greedy. We should buy low and sell high. These are all fine. These are truths. I think we agree with them. But how do you actually do it? It's so hard, And it's particularly true that because when bad things happen in the stock market, I've said this before, it's not an isolation. It's usually just one of many bad things that are happening. I mean, when we look back to 2008 and 2009, it wasn't just that the market was down. Housing crashed. Our financial system was in turmoil. We thought it might actually go belly up. Big banking firms were going under. Banks were going under. Mortgage companies were going under. Our politicians were all blaming different people. Remember the whole bailout thing? Should we do it? Shouldn't we do it? Do we bail out Wall Street or not? Do we bail out banks? Do we bail out the auto industry was collapsing? I mean, it wasn't just the stock market. I mean, it seemed like it was everything. And how do we keep ourselves together in that moment when things are looking very grim? And so, what I'm not going to give you today is a magic bullet because, frankly, sticking to your investment plan in those times is difficult. And I'm not going to pretend for a minute that it's easy. I think for most of it's not. I will say that during that time I didn't change my investment plan, so I kind of, I guess I'm kind of proud of myself that I did that. I don't know if proud's the right word. I'm grateful that I did it, and particularly in hindsight. But you think, well, if you've done it then, you'll do it again, right? Actually, sticking to your investment plan, in some ways it gets easier with experience because you've lived through these bad markets. But in some ways it gets harder. Frankly, it's easier to live through a down market when you have $10,000 invested because, you lose 40%. Who wants to lose $4,000? But what happens when you have $100,000 and now you're losing 40, or $1 million and now you're losing 400? I mean, the numbers start to get big, and so in some ways you have the experience to fall back on, but in other ways you're investing more money. It doesn't always get easier. So I wanted to kind of walk through some tips that I think can help you stick to your investment plan. So I've got. I guess I'm going to do 9. I got 9 of them listed here. So let's kind of walk through them. The first one is set the right expectations, and what I mean by that is recognize that given whatever your asset allocation is, it will lose money if you're investing for any length of time. If you're investing for retirement, or even a 529, but let's say retirement, you've got presumably decades. Even if you're near retirement, you're going to not only invest up until you start retirement, but through retirement. So even if you're, say, 10 years away from retirement, your investing horizon, if you're planning for a 30-year retirement, it's 40 years. It's a long time. And so we have to set the right expectations. And here's what I mean by that. And I'm going to link to this article in the show notes. It's a very good article from Vanguard. And what it does is it shows you the historical performance of different asset allocations. Different asset allocations. And it starts at 0% stocks, 100% bonds, and then it goes to 20/80, 30/70, and so forth, all the way down to 100% stocks. And for each allocation, and this is data from 1926 to 2013, it shows you the average annual return. It shows you the best year for that allocation, the worst year, and then the number of years with a loss. So let's go to, let's say 70% stocks, 30% bonds. That's probably a fairly common asset allocation for folks investing for retirement. Average return, 9.2%. Best year, 41.1%. Anyone want to guess what year that was? How about what decade? I'll give you a hint. The best years almost always follow shortly after the worst years. Sure enough, the best year in this portfolio, 1933, 41.1%. The worst year, 2 years earlier, 1931, it lost 30.7%. Now that's not stocks. That's this portfolio of 70% stocks, 30% bonds. Out of the 88 years tracked, how many years were there with a loss? 22. All right. And I mention this because if you're at 70% stocks, 30% bonds, you really need to study this chart. You need to say, okay, if I'm going to invest for the next 30 or 40 years, I have this to look forward to at some point. I mean, it may not be, and it probably won't be exactly like 1931 and 1933. Maybe you won't lose 30.7% in your worst year. Maybe it'll quote unquote only be 25%. Then again, it could be 35%. But the thing is, if this is your allocation, it shouldn't come as a surprise to you. You should use this to set your expectations. And I think that's at least the first step. That's the first tip. You need to understand what you can expect given your asset allocation. Again, I will link to this article. It's got a very long URL, so I won't bother reading it, but I will link to it in the show notes, which you'll be able to find at DoughRoller.net/podcast118. It's a very good chart. It's a great way to say, okay, this is my allocation. These are my expectations. This is what's happened in the past. The future won't be exactly like it for sure, but this is as good a guide as we've got. And particularly if you've got more equities than fixed income, more stocks than bonds, this should scare you just a little bit, or at least prepare you, right? So that's tip one. You need to understand and set the right and reasonable expectations given your investment portfolio, your asset allocation. Number two, we've talked about this, but you need to have an asset allocation plan and you need to stick to it. We've talked about that. But what I mean by that is you need to rebalance. Now, you might say, well, that's not really a tip, Rob. I mean, the whole point of this is to show us how to do that. So this doesn't really qualify as a tip. Well, here's what I mean. Number one, write it down. It can be a simple email to yourself. What is your asset allocation? You can use a spreadsheet. You can use a tool. You can use Morningstar. You can use Personal Capital. You can use a piece of paper and a pencil. What is your asset allocation? Write it down and write down your rebalancing plan. We've talked about both of these really quite a lot over the last 100 plus shows. But if you're fairly new to the podcast, let me look up some episodes to give you. On the asset allocation, I would start with podcast 25, DoughRoller.net/podcast 25. That's probably a good a place to start, and it kind of walks through how to think about an asset allocation plan and how to create one. And then for rebalancing your portfolio, that's episodes 51 and 52. But I would write down your rebalancing plan too, and it might be nothing more than rebalance once a year. I think if that was someone's approach, it's perfectly fine. I tend to do it a little more frequently, but once a year, twice a year. But you want to write it down. Put it in writing somewhere so that you know exactly what your plan is, the target you're aiming for, and how you're going to do it. The rebalancing portion of it is critical because rebalancing forces you to what? Sell high and buy. I had to think about if I get this right. Sell high and buy low, right? So if you just take a simple example of 50% stocks and 50% bonds, if stocks take off and all of a sudden you see you're at 60% stocks and 40% bonds and you rebalance, you're going to sell your stocks. Those are the ones that have been winning. Enough of them to buy the bonds, which have been losing, right, because they've gone down, excuse me, to get back into that 50-50 alignment. So rebalancing is the tool, the key that kind of forces you to sell high and to buy low. But again, tip number two is with your asset allocation plan and your rebalancing plan, both of them, they're both critical. Write them down. Okay, tip number 3. This will come to the surprise of absolutely nobody that's listened to this show. Favor index funds. And here's the deal there. When I was learning to invest and kind of a beginner, I invested in Bill Miller's Legg Mason Value Trust. Bill Miller is a very well-known money manager, very bright guy, has an incredible track record. And his Legg Mason Value Trust mutual fund beat the S&P 500, I think, for 15 years. It was a phenomenal run, and then it cratered. I mean, that's just what happened. It had some really bad years. So I was in the middle of this. I was probably at year 10 in his run, and I'm thinking to myself, someday this mutual fund is going to underperform the market. It's had a great run. Maybe it'll continue for a while. It's not going to beat the market forever. And I asked myself, when it starts to underperform, am I going to have am I going to stick with the fund? Am I going to have confidence in the fund management? What if Bill Miller leaves? Management changes. Am I going to have confidence in this fund and stick with it? And at the time, I concluded, no, I won't. And I thought, if that's the case, I ought not be in it now. And that was really what triggered me to move, not every investment I have. I do have some actively managed funds, as I've mentioned in the past, but to move the core of my portfolio to index funds. And here's my thinking. If an index fund is down, I know it's not because bad management. I know it's not because they have stock pickers that are just doing a bad job or have lost their touch or whatever. I know that it's down because the market is down. And I have confidence that over time, the market, and it could be the S&P 500, it could be emerging market index, foreign funds, bond index, doesn't matter, over time will grow. And it won't grow every year. They'll have years that are losses, but it won't be because management of the fund has messed up or lost their magical touch. And so for me, index funds were a big part in helping me stick to my investment plan. And I think the same can be true for you. So that's part of the whole process, and why I have this as tip number 3. It doesn't mean that everything you own has to be in index funds. I don't believe that to be true. I think it's good to look at your portfolio as a whole, which is what we do when we do asset allocation. You have some stocks, you have some bonds, you may have REITs, emerging markets, whatever. But at the end of the day, what you're looking at is the overall performance of the entire portfolio. I don't think you need every single fund to be an index fund in order to have, to reap the benefits that I think index funds can have in helping you stick to your plan. But I do think the core of your portfolio needs to be in index funds. And that brings to mind an article that I read on Wealthfront. Wealthfront is a robo-advisor like Betterment. They have a blog. And they have an article called Passive Investors Need Less Handholding. And it was the basic idea was that when you look back at the bad markets, folks that were in index funds were much less likely to sell out in a down market than those in actively managed funds. Now, that doesn't mean that folks in index funds didn't sell. They did. There were outflows. And that in part is why the market goes down. But the outflows were a lot less than actively managed funds. Now, I don't put too much weight on these kind of studies because you've really got to look at the why. But I do think part of it is the fact that folks in index funds understand that sometimes the market will be down. It's not because of management. I will link to this article in the show notes. I think it's a very interesting read. They have an interesting graph on this, or actually a couple graphs that you'll see if you go to that article. But I will include a link to it in the show notes. Okay, tip number 4, keep your debt low. Now, this may seem strange, but this is so important. Don't look at your investments in isolation from the rest of your finances. They are all related. I think it's easy, to kind of say, okay, my retirement accounts, my 401k, it's over there. It's got nothing to do with my credit card debt. Oh, you might say, well, sometimes you have to prioritize, so maybe there's a relationship there. They're all related. Trust me. If you have no consumer debt, you can withstand a downturn in the market more than if you've got a ton of debt and you're trying to save and invest, but you've got all this debt that you're dealing with. The more secure and solid your finances are, I think the easier it will be to deal with the ups and downs of the market. Now, I don't think that means pay off all your non-mortgage debt before you invest anything. I think that could be an okay approach. Depends on circumstances. But I kind of cringe when people say, "Yeah, I've got $50,000 in credit card debt and $100,000 in student loans. And I'm going to spend the next decade paying them off before I invest for retirement." Ugh. I don't. That's just not an approach that I agree with. But you got to look at your entire finances as a whole, and if you keep your debt low, and I'm really focused on non-mortgage debt. Hopefully, eventually eliminating it, or if you don't have it now, don't go into debt. If you're just starting out, you don't have any debt, keep it that way. That will have an impact on how you handle, or how a lot of people will handle a bad market. That's one of the reasons, by the way, that I like tracking my net worth in a balance sheet or personal financial statement. In fact, as you know, if you've been listening, we covered that in a podcast 114. We looked at 3 tools to track your net worth. But one of the things I like about it is it forces you to pull everything together on your balance sheet. You don't have just your emergency fund and your other cash. You have your investments, taxable, and retirement. You also have all your debt, right? All in one place. And you can see how all of these things are working together, hopefully for the good. But that's one of just another reason I like so much tracking your net worth. It's a very holistic approach to your finances. But I guess the key here in tip number 4 is don't isolate your investments as being something separate from the rest of your finances. They really you look at them as a holistic, in a holistic way, because one does absolutely affect the other. Okay, tip number 5: keep your fees low. Now, we've talked about fees and the importance of keeping them low, just from a pure numbers perspective and performance, and you want to keep as much of your money as you can, right? But I think fees can help you stick to your investment plan. It's one thing to see an index fund that go down because the market goes down and you're paying 5 basis points, 10 basis points, maybe 20 basis points. But when you see an actively managed fund where you're paying 1 or 1.5% and it's going down, it's even harder to stomach, and it's harder to stick with that plan. It's true too if you're paying a heavy fee, advisory fee. And again, I think there is certainly a good place for advisors, and some people need them or want them. But the more you pay in fees, the harder it is to stick with those investments when the market's down. It's funny, people don't seem to care as much about their fees. They should, but they don't seem to care as much about the fees when the S&P's up 30% like it was last year. But to have it scraping the bottom at 1 or 2% or losing money, those fees really come into focus more. So I think keeping your fees low in good markets and bad all the time can help you stick to an investment plan. Tip number 6, this won't apply to everyone, but if you can, diversify your income streams. And again, this is kind of like the flip side of keeping your debt low. Your ability to generate income, I think, goes a long way to your ability to withstand a down market. If you're confident in your job, your career, your business, your ability to generate income, it becomes easier to deal with the down market. Now, what does that mean in terms of diversified income streams? It could be starting a side business. That's one option. That's effectively what I did with the blog. I didn't really intend to do that. It was more of an accident, but that's how it worked out. It could mean just continuing to develop in your career and continuing to get relevant education and relevant certifications and relevant experience, so that you become more valuable to your current employer, to future employers. So there's no sort of one right way here, but I think the more you are confident in your ability to generate income, again, whether you're self-employed, you're an employee, maybe a combination of the two, I think you'll have a stronger the wherewithal to withstand downturns in the market. I found that certainly to be true with me. Tip number 7, don't look. When the market's down, if it's really going to affect you, don't look at your portfolio. Ignore it. I've done that before. I don't kind of do it so much now, but there were times when I just look, the market's been down, it's kind of been in a slump. I'm not going to look at my portfolio. It's not going to look. And if that helps you, then that's what you ought to do. There's no reason to check your portfolio every day, or even for that matter every month. Particularly if you only rebalance once or twice a year, you don't, in theory, have to check it except for when you rebalance. I suppose you might check it every now and again just to make sure it's still there, and I get that. But if it's really, if it's really affecting you and the market's down, just don't look. Sometimes I'll wait until the market has a great day, then I'll go look. So, it still may be down from the last time I looked, but maybe not quite as bad. Tip number 8. This is, I think, in some ways the most important, or one of the most important in this list, and that is to become an historian. I think the more you know about the history of investing and the history of the stock market, the more prepared you are for both the good years and the bad years. And you think about Warren Buffett. I mean, he is probably one of the most prominent historians of the market. Of course, he's lived through a lot. He's experienced a lot. But the more you know about the market, I think the more, for one thing, you're less likely to be surprised when the market is down significantly, or for that matter, when it's up significantly. I've lived through some things, right? I've lived through the 08-09 crash, the 2000-2001 crash. I remember the market not doing well in the early 90s. You had the 87 crash. That was a big one in one day. But there's a lot of things I didn't live through. But the point is, excuse me, you really want to become, it's a history lesson. You really want to know your history when it comes to the stock market. It will help you to work through those difficult times, and they will absolutely come. There's no question about it. If you're investing for any length of time, you will live through and invest through some very difficult markets. Now, let me give you 3 suggestions on what you might read to get some of that history. Some of these, particularly one, might be a little more dense for some. Depends on how much you enjoy all of this. The first is A Random Walk Down Wall Street. Burton Malkiel wrote that, and a very well-known investing book. Many of you have probably already read it, but I think it gives sort of a good perspective on investing generally, but also a history of asset prices in the stock market. So that's one book I would suggest. The other one, this one's a little deeper, but it's Security Analysis by Benjamin Graham. This is a book that Warren Buffett kind of views as his Bible. It's more designed for the fundamental analysis of individual stocks. But the thing I like about it is, it was written at a time when, and following a time when, the markets went through, a significant upheaval. And so you get a sense of, what the markets can do over a decade or more and how they can be brutal for a while. And so in that sense, I think it's a really good source of information. The third one are the letters to Berkshire Hathaway shareholders that Warren Buffett writes every year. Those are fantastic, and they're available for free on the Berkshire Hathaway website, and I will link to those in the show notes. There are many others, but I think these are certainly 3 good ones that can kind of start you on your way to understanding, the stock market and kind of its history. The final tip that I would offer is this. Is to make changes to your asset allocation very slowly and deliberately. Oftentimes we can decide on changes to our asset allocation, and we have to be very honest with ourselves. Are we making these decisions because it's right for our investing goals and our time horizon, or are we making changes because we're unhappy with the short-term results of a particular asset class? I had one reader email me when I mentioned that I was going to sell my commodities fund, which, by the way, I haven't done yet. And he questioned, are you doing that because commodities are down? And he pointed out some research that says, commodities can be a very good part of a well-diversified portfolio. And I think that's a fair and honest question to ask. I've not sold my commodities fund yet, in part because I do make changes to my asset allocation very, very slowly. I'm not a big fan of commodities. I do understand the argument of how they can help diversify a portfolio. But I'm also just not a big fan of investing in commodities, and I think there are other ways to diversify a portfolio. But that being said, I make changes to my asset allocation, very slowly. I'll think about that kind of decision for sometimes months, but before I actually make it. And that's true not just in maybe in this case getting rid of an asset class, but also if I'm going to make changes in the allocation. So I'd mentioned a while ago that I was shifting from 80% equities to 75%. Well, that's something I gave a lot of thought to. And when I made the shift, I made it gradually. I didn't make it all at once. because I wanted to live with that decision, and I wanted to make sure I was doing it for the right reasons. Now, in that case, I was less concerned because I was making that decision when stocks were at all-time highs. With my commodities fund, they're low. I've lost money in that fund. So you think, well, am I making that change because I'm unhappy with the short-term results? I can tell you that my total loss in that fund relative to other things and other losses that I can experience even in a single day is not that significant. So I'm reasonably confident that's not my motivation, but I think it's an absolutely right question to ask. We have to be honest with ourselves. Why are we making these changes? So when it comes to changes in your asset allocation, I would suggest that you make those very slowly. So those are the 9 tips. For me, I think using index funds as a core part of your portfolio, keeping fees low, and becoming a historian of the market and setting the right expectations, those 4 to me are probably the most important. But I think all of these tips hopefully can help you not only come up with the right asset allocation plan to begin with, but then once you've done that, hopefully these tips can help you stick with that plan in both good times and bad. By the way, if you have other tips, other things that have helped you stick with your investment plan, please let me know. Shoot me an email, dr@doughroller.net. I'd love to hear about them, and we'll share them in future episodes. Okay, on to the tip of the day. In this case, it's a tool that a reader whose name I completely botched the last time I mentioned an email he sent me. And I think I've got it this time. It's HaRoute. I think I got it right, HaRoute. Anyway, he'll correct me if I didn't, but he helped me with the pronunciation of his name. I think that's right. He actually sent in 2 tools, asked me if I'd heard about them. The first one is called Coin, or the URL is onlycoin.com, onlycoin.com. And the second tool is called Plastic. So it's just simply plastic.com, except it's spelled Plastc. There's no I. Plastc.com. What are these? They're both, you can think of them as payment cards, credit card or debit card, but they're electronic, if you will, and you can actually load all of your credit cards and your debit cards and your gift cards onto these cards. So rather than carrying, 1, 2, 3, 5 credit cards and your bank ATM card and maybe 3 gift cards that you got, you can load them all onto each of these cards. These are competitors, so you could pick one. And then the card itself is kind of like has a touch screen, sort of, where you can select which card you want to use for a given transaction. So rather than carrying all your plastic around, you can just carry one card and you're good to go. And in looking at both of them, I think the plastic card I found a little more robust and more I like the way it interfaced on the card itself to select the different cards that you want to use. But they both basically do the same thing. Now, neither one of them are available. You can pre-order either one. Here's the thing. They're expensive. The Only Coin, $100 plus shipping. The Plastic card, again, Plastc.com, $155. And it won't be available till summer of 2015. So this is interesting. I mentioned it, because I thought these are pretty, cool ideas. I like them. Although I do wonder if they're ever going to take off, and here's why. Eventually, we won't use plastic of any kind, I assume. We'll just use our smartphone or our smartwatch. Certainly, Apple Pay, which they announced not long ago, is moving in that direction. You'll be able to simply select the card you want on your iPhone and wave it near a payment device or scan it, and it'll charge your whichever credit card or debit card you've selected. The same is going to be with the Apple Watch. You won't need any plastic, let alone these cards. So I kind of, frankly, think their days are already numbered, and they haven't even launched yet. But that's just my take. They are really cool cards. I don't think I would spend the money for them, but I wonder if you would. Maybe you guys like it better than I do. And I guess I shouldn't say that. I think they're really cool. It's really cool technology. But given the price and given the fact that I assume we're going to be moving away from all forms of plastic at some point in the not too distant future, I kind of wonder what the shelf life of these two things are going to be. But I thought I'd mention to you, you can check them out. They're kind of cool. If you have your own views on this, shoot me an email, dr@doughroller.net. Would love to hear what you think about them. And as I mentioned earlier, I'd love to get your resources, tools, calculators. Shoot me anything. And I kind of save all of these. I save everything in Evernote. My Evernote account has gotten bigger and bigger with just a ton of things that I've saved in Evernote through years of blogging. And but I love to see new gadgets, new tools, new resources and calculators. So I appreciate it. I appreciate receiving these, and you can check them out. Let me know what you think. Well, listen, I hope you have a great day, and I hope these tips will help you stick with your investment plan. That is so important. If you have other tips, please let me know about them. Would love to hear from you. Hey, until next time, remember, the best thing money can buy is financial freedom.